Hi, I'm Thomas. Welcome back to the course Financial Institutions and Markets. Today's topic is financial institutions and money creation. We can classify financial institutions in two categories: deposit-taking institutions and non-deposit-taking institutions. We'll be focusing on the first category in this lecture. The central bank is a government entity, and the central bank is involved in lending as well as some government functions and some policy activity. Commercial banks are private entities owned by investors, and commercial banks are where individuals and companies go to make deposits and borrow money. Non-deposit taking institutions. Here we have three examples. Insurance companies receive funds through premium payments from customers and pay out funds when claims are made by those customers. And while they have the funds, in the meantime, they're investing in various assets, stocks, bonds, real estate. Pension funds receive money either from employees or their employers, which will be invested until the employees retire, and then those funds will be paid out to the employees as retirement benefits. And investment trusts or mutual funds are a collective form of investing. A group of investors contributes to the fund, and the fund will make investment decisions, typically purchasing stocks, bonds, and real estate. So let's look in more detail at the activities of the central bank. The central bank sets monetary policy. What that means is they put policy into place that has various goals, and the primary goal or a key goal is to control the inflation rate in a country. And we'll look at the end of this lecture, we'll look at some central bank policy activities. The central bank also makes loans. They're not making loans to individuals and companies, rather they're lending to banks and they're lending to the government. Additionally, the central bank manages a country's national debt. They will hold the foreign currency reserves of a country. And finally, the central bank is responsible for issuing currency, the notes and coins that are in circulation in a country. In contrast, what do commercial banks do? Commercial banks receive deposits from customers. Those customers are individuals and companies. They also lend money to customers. So a bank will take in deposits from some customers, make loans to other customers, and in some cases take deposits from and make loans to the same customer. The earnings model of commercial banks is that they pay low interest rates on the deposits that they've taken in. They charge higher rates on the loans that they're paying out, and the difference between those two rates, the interest rate on loans made minus the interest rate on deposits taken in, equals the interest rate spread. Here's a simple example of calculating a bank's interest rate spread. The weighted average lending rate. So a bank won't have one lending rate. A bank won't have one deposit rate. They'll have a variety of rates depending on, perhaps in the case of loans, the size of the loan, the quality of the borrower. And in the case of deposits, often the size of deposit and the term of the deposit, how long a deposit is committed to being in the bank, will govern the rates on the loans and the deposits. So here we have weighted averages, and we're going to see how to calculate a weighted average shortly. The weighted average lending rate, 5.24%. The weighted average deposits rate, 3.40%. And the interest rate spread is the difference between those two rates, which is 1.84%. So this positive interest rate spread is the key method in which a bank is creating profit for its shareholders. So let's look at the calculation of a weighted average interest rate. In our example here, this is the weighted average deposits rate from the previous slide. So let's see where this calculation comes from. We see two classes of deposits, Class A and Class B, and Class A's percentage or weighting is $40 divided by the total of $200, which equals 20%. And Class B has $160 divided by the total of $200, resulting in a weighting of 80%. And now in calculating in the bottom half of the table our weighted average interest rate. I have a 20% weighting for Class A times the 1% interest rate, which gives me a contribution of 0.20%. And using the same math with the Class B, weighting of 80% times the interest rate for Class B of 4% results in a contribution of 3.2%. And I add these two amounts to arrive at my weighted average interest rate of 3.40%. So this is the weighted average rate the bank is paying out on deposits, and we would use a similar process to calculate the weighted average interest rate received by the bank on the loans made to customers. Now we're going to look at the concept of money creation. So let's define some terms to begin. For a bank, assets primarily consist of reserves and loans. Reserves are made up of two components: notes and coin, which we would refer to as cash, plus central bank deposits. So when a bank deposits money, when a commercial bank deposits money at the central bank, that's a form of asset, and that combined with cash equals the bank's reserves. The other asset, the prime other asset of a bank, is loans made to individuals and corporations, loans made to customers. So our assets are our reserves plus our loans. The primary liabilities of a bank are deposits taken in from customers. And when we add deposits to cash outside of banks, so cash in the pocket of an individual, or in the cash register at a company store, deposits plus cash outside of banks equals money. The reserve ratio, this is an important calculation to know. Reserve ratio equals reserves divided by deposits. So our reserves, these two components, notes and coin plus central bank deposits, that totals to reserves divided by the deposits held at the bank equals the bank's reserve ratio. So what is the process of money creation? When a bank lends money, there's a change in the asset side of the balance sheet. We're moving money out of reserves and into loans. But there's no change on the liability side of the balance sheet. There's no change in deposits. Where does this money go? This money will go from the borrower to a third party. The borrower is going to use the money and make a payment to a third party. And that third party will eventually deposit the cash received into a bank. So this results in an increase in deposits. The final result is an increase in money. There is an increase in deposits. Deposits are one component of money. So when deposits increase, money increases. Now, what is the effect of money creation? When banks lend, there is a decrease in reserves and an increase in loans. So as we said before, that's a change in asset composition. No change in total assets. We've changed the composition, the makeup of assets. Decrease in one category and increase in another. There's no change in deposits, so we haven't changed the liability side of the balance sheet. The result is a decrease in the reserve ratio. And the lower the reserve ratio, the higher the risk at the bank. Higher reserve ratio is a safer position. Lower reserve ratio is a higher risk position. Let's look at an example. We have on the left side of the screen the bank position before making a new loan, and on the right side of the screen the bank position after making the new loan. So we see prior to the new loan we have total assets of $970, total liabilities and equity of $970, and a reserve ratio of 15.3%. What happens when we make a new loan or loans of $30? Well, we have a decrease in notes and coin. the $50 we started with decreases by the outflow. We're using some of these notes and coin to make a loan, so we go from 50 minus 30 to a new amount of 20. We're subtracting 30 to decrease the notes and coin to 20. Notice the loans amount went from 860. With new loans of 30, we add 30 to get to a new loan balance of 890. Again, a change in the composition of assets, but no change in total assets. Total assets was 970 and remains 970. No change in the liabilities and equity components of the balance sheet. Deposits and equity remains the same. And we go to our summary at the bottom. Reserves has decreased. The initial reserve amount, 110, consisting of notes and coin plus central bank deposits, is now 80. Because of the decrease in notes and coin, 20 plus 60 equals a lesser amount of 80. Deposits has not changed. And notice that our reserve ratio has gone down from 15.3% to 11.1%. The result of a decrease in reserves and no change in deposits. This is an example of money creation within one bank. We're going to take a break, and when we return, we'll see how money creation works in the aggregate or the total banking system. When money is lent by one bank and those funds are deposited by the recipient of the money into another bank, then there's a chain reaction that's happening. There's an effect in the overall, in the aggregate banking system. And when we return, we're going to see how that process works, how money creation works on an aggregate basis in the aggregate banking system.